Tonight, savers are losing billions. Property on a knife edge. Is now the time to invest or sit tight? Hello and welcome to Money Watch. Tonight we're in London, the financial capital of Europe and home to a vast savings and investment industry. We're all being encouraged to save more, but with interest rates so low, what's the best way to conserve our cash?
For many of us in Britain, our most significant savings are tied up in our homes. And with periods of spectacular price rises over the last 30 years, bricks and mortar have looked, well, as safe as houses. But after the sharpest fall in house prices for decades, followed by a faltering recovery, are our homes such a reliable asset? That's what Andy Verity's been trying to find out.
Whatever happened to the house price crash? I'm hoping I might find the answer here in Sheffield. Across the country early last year, the average house had gone down by £38,000. But even while the worst recession in more than 60 years was still on, prices bounced back, and they're now less than 10% below their peak. That might seem to prove that no matter when you buy, your dream home is always going to make you money. But if you're thinking like a professional, is now really a good time to be making the biggest investment of your life? Here in Sheffield, the average house price surged by nearly £20,000 last year. But now prices are slipping again. In the past, Alan and Rather Bridger have each separately made more on property than they could ever save. Then they got married, and now they're looking to their family's future. They feel ready to buy. So how do you look on property as an investment at the moment, Alan?
I think property is still a good investment. You know, you put your savings in a traditional bank and people are wondering, is it safe? Whereas in property, there's bricks and mortar, so it's still a good place to put money. And that's what I've done.
Encouraging them to buy is their estate agent, Linda Crapper, who says she's made money on her property investments for 3 decades.
On the right-hand side over here, I've just bought this recently. I've got a couple of properties there which have been fantastic investments. This is a car park I partly own. This is my latest investment. My property portfolio at the moment is worth at least £2 million plus. You can't go wrong with bricks and mortar is my motto.
I can think of a way that it might go wrong. It might go wrong like this. You might buy in a peaky market where prices are very high compared to earnings. Then 5 years later, you might be forced to sell. What if you can't sell it because the market's frozen and because prices are falling?
Even if it dips, as long as you've put a substantial deposit, you've done your sums and your homework, it will always work for you.
That's Linda's point of view. But could her confidence be misplaced? If you think house prices are going to fall to more normal levels, you might save big money by waiting to buy. Right now, the average house price is about 5 times what the average person earns. But over the long term, that average number is 3.5 times. So if prices are going to fall to that level, you could save £46,000 on the average house. Of course, if you don't think house prices are going to fall, you don't have to worry about that. Professional investors don't like buying assets when they're overpriced.
You're looking to try and buy a house, yeah. 350,000. Where do you start?
Henry Pryor is a professional property finder who's in Sheffield to help Alan and Rather find a good investment. So what does he think about buying now? Would you acknowledge that house prices are now overinflated?
Well, it entirely depends where they are. Look at that backdrop. Here's Sheffield. House prices in Sheffield are still trading at a 15 to 20% discount to where they were at the peak of the market. Because people can't be certain about what house prices are doing at the moment and what the future direction of house prices is going to be, that uncertainty gives the professional property investor an opportunity to negotiate, and to negotiate hard.
Henry wants Alan and Rather to approach their buying decision with their heads, not their hearts.
OK, I think you're going to like this. It's good space, isn't it? All done very recently. Dining room here and then through to the garden. It's all properly done, isn't it? East facing morning sun.
Yeah.
So there you've got it. Perhaps more than you were expecting, I think. I think it's got lots of potential if you're just looking solely at the money side of it. If you're looking as an investor, it's got lots of space, lots of flexibility, and most importantly, the people that live here, they are committed sellers. As an investor, that's what you want to be seizing upon, and that's what you want to take advantage of. So,
Not. Somewhere we've got to be happy. I mean, we haven't spoken about it, but for me, it's not the house I'd want.
So, no luck for Henry. But Linda thinks she's found a home they will fall for, and it's in their area.
Ready? Yes.
Lovely big crew lounge dining room.
It's a nice sized garden and it's flat, which is exactly what we need. It's a nice road to live on. And it's very close to the school. We could walk to school from here. I feel quite positive about it. It's in the right area.
Yeah, I think it's a potential good buy.
But will Henry agree with that? There's a trick professional investors use that anyone could copy to work out if a house is a good value investment or not.
well, one of the first things we do is try and work out whether the numbers actually stack up. And one way of doing that is to look at the rent that you might notionally expect to get on this house compared to the price you're going to be paying. Here in this house, we reckon we could get £10,000 a year, and we look at that as a proportion of the money that's being spent on the house in the first place. In this case, £250,000, and work out what that rent is as a proportion of the money you're spending, which in this case is 4% gross.
OK, now that's like a rate of interest, isn't it?
Absolutely, it's what we call the yield, and that enables you to be able to compare this asset class with others, such as a bank account, stocks and shares and the like.
4%? That's not much more than I could get by putting my money on deposit without taking any risk to my capital.
Absolutely, and you wouldn't have the associated concerns that, that these guys will have in terms of buying bricks and mortar.
So, Alan Rather, what do you think? I mean, comparing that with a deposit, you're not getting a great yielding asset. It's not a particularly good investment.
Well, we've got to live somewhere, and if we don't buy, then we have to rent. And I still think long-term, mid-term, as an investment, property is good, and I think it is an investment which we can enjoy because we're living here.
I think the priority is to get the house that we want in the area that we need to be in, and from a heart point of view, that's my priority.
Your heart rules your head?
Yes.
What I've come to realise is that people tend to buy houses not so much because of, but in spite of whatever's happening to prices. And for decades, that didn't really matter, because if prices went down one year, they'd go back up again. Right now, to some cold-hearted investors, houses look overpriced, a risky investment. But for determined buyers, that hasn't yet shaken their faith in bricks and mortar.